we often talk about volatility, and we use a lot of statistical terms, so we talk about tracking error, we talk about standard deviation. But when we really think about risk, what we're talking about is the potential for permanent capital loss. And that's how we approach it. So really what we're talking about is not losing money, or more eloquently is to try and avoid losing money. And while we all understand what's going on, I think often the question that we don't ask is, and so what? And so that's kind of the thing that we try and address within our investment process. So we take a scenario-based approach that basically asks the what if, like so what if? What if this happens? What does it mean? How does that impact into our thinking around how we construct portfolios? When we actually get to constructing portfolios, we really think about it on from different time horizon perspectives, right? So different risks will play out over different lengths of time and periods. So we take Russia, Ukraine, that's been ongoing for quite a while, but so more of a medium-term risk going forward. But there are other risks that are shorter term, but really we need to think about the risks over multiple horizons. And so the way we construct our portfolios really reflects that. So the starting point for us is really strategic asset allocation, so not a new concept. Most of you will be familiar with this. But I guess the point of difference that we have in our process is actually around the inputs that we use. Now, they're not radically different, but the way that we go about generating those inputs is slightly different. So most strategic asset allocation processes involve forecasting risk and return across different asset classes and then building a portfolio for 3 to 5 years or longer. Our view is that a lot of those forecasts that are generated expect a normal environment over the next 5 years. So in a normal environment, if nothing happens over the next 5 years, this is generally what you can expect equities to deliver. Now, we all know that there are lots of things going on in the world, and a normal environment is actually quite a rarity these days. And so we take a scenario-based approach to our forecasting. And so what we do is we say, well, look, this is the current state of play of the world. This is what it looks like. What's the potential pathway from here? And we'll map out 3 or 4, maybe 5 different pathways, a high inflationary environment, central banks pivoting, basically macroeconomic themed pathways that we might end up following. And then we assign probabilities to those. So through those pathways, we can say, well, in this environment, if we follow this pathway, we can expect equities to do this, we expect bonds to do this, and the probability of this event or this pathway taking place is Y. And then we can construct a view of not just a base case normal environment, but more of a probability-weighted kind of forecast based on expectations of different types of environments that may play out.
Well, obviously, return is what it says on your statement, on your performance report. But that's backward looking. That's already happened, and you can't change that. But what you can change, what you can prepare for, is risk, and that means positioning for the future. That was an environment where the risk of inflation was rising. You already had the risk around inflation in the sense of coming out of a pandemic and supply constraints, but what you didn't know at the time was Ukraine, and given that environment where you've got a zero expected return and actually high risk, it doesn't make sense to take that risk. So what you really need to do is A, have the flexibility to only take risks that where the returns stack up, but also to be able to hedge the risks where it doesn't make sense. And that's how in what we do is we take a client's risk tolerance and then maximise the return for that level of risk, rather than let risk be the outcome of your asset allocation.
Look, I think for us, diversification means the same as everyone else here. It's one of the few free lunches in finance. So as a result, most of us will be using that as part of our portfolio construction process. We certainly do that as well. That's why we have investments in multiple asset classes. That's why we invest in broad market indices as well. But the way we see. When we constructed our portfolios from the outset, it was designed for for those accumulators who might be a little bit risk averse, or for those retirees who might be heavily exposed to sequencing risk. From our perspective, for those types of investors, it's particularly important to be able to very robustly manage or try and mitigate as much of the impact from a large market drawdown as much as possible. Diversification, we see it's an implicit tool to manage risk rather than an explicit solution. So the way that when we constructed our portfolios, we thought it's important to complement diversification with a more explicit strategy that manages risk for them.
Well, the first thing I'd like to talk about is just what the benefits and limitations are of a quantitative model. It has a lot of very significant benefits. It's going to provide a good rigour and discipline for your process. It allows you to capture relationships that may not be immediately apparent and be able to react to them a lot more easily. And finally, often most importantly, it helps you take the personal emotions and biases out of the equation. It helps to ensure that that's not going to be what's driving your process. For us, we have more or less two complementary risk processes going on. We regularly rebalance our portfolio's risk exposure, and it's largely a risk budgeting framework there, attempting to ensure a relatively smoother amount of risk in the portfolio. So when markets are more volatile, we're going to pull back from the risky assets. When markets are relatively steady and stable, we can go harder into them. And for that, we do have quantitative modelling to keep track of current market risk and determine what areas do actually need us to pull back, etc. Now, that is essentially an input into what then becomes a more qualitative process. We do want to be able to consider the results that are being produced in that and test them essentially to see if they are essentially reasonable and if there's anything that they've been missing. Because quant models also have their own limitations. For example, it's not going to capture anything that you haven't actually put into the model, and often those sorts of things are significant. It's not going to be able to... If I can put it this way, quant models tend to have hidden assumptions, and the most obvious one is they'll have the assumption that essentially the future is going to behave in line with what you've used to calibrate the model to begin with. And at times when that breaks down, then yes, you do want to be able to gauge whether that's working properly.
So the built-in risk management strategy that we run essentially relies on two fairly simplistic but systematic techniques. So the first one is essentially a volatility targeting process. And what that is we use our internal models to essentially make a short-term forecast of where volatility would be in the short term. And based on that, we use instruments such as futures contracts to then dynamically adjust the exposure to equity markets to try and stabilize the volatility of the portfolio at a certain level. The reason why we think stabilizing volatility of a portfolio is important is because when you think about a client entering a balanced fund, for example, they're expecting, standard deviations of around, 7% to 10% or so. What you don't want them to experience is that standard deviation shooting up to 20% just because COVID came around or just because we had a big sell-off this year. So, one way to manage that is to actually control the volatility of the fund rather than manage it to the SA itself. So that's one component of it. The other component of our risk management strategy is what we call a put option replication exercise. So it sounds complicated, but in essence, it's actually a very much a textbook method of replicating a put option.
A put option is really just sits in a bucket of things we call preservers, and they're things that will go up, when equities go down with bit more certainty. But we think about it the way I think about it is a quadrant of efficacy and cost. And so, and those things like put options and rates and currencies kind of move around in this quadrant, and sometimes they make sense from an efficacy point of view. In other words, they're going to work. Like a put option generally always works. But then they could be in the wrong quadrant from a cost point of view. And so, when that's the case, you might not use put options. You might want to use currency more, or maybe you just want to use cash, right, and reduce your equity levels. So yeah, it's about being dynamic, and it's not a fixed approach. It's active, and it's taking into account valuations and where you are in the cycle.
Yeah, look, I think for us, we found the managed account structure quite flexible to use. The way that it certainly wasn't easy, but the way that we implemented the dynamic futures trading or derivatives trading is by actually setting up our own unit trusts that explicitly just trades those derivatives within that unit trust structure, and then that way, because we can control the allocation within the managed account structure about how much you can invest into those unit trusts, then we can actually very accurately manage the amount of derivative exposure that we want in our portfolios within this whole managed account framework. So it was difficult to get it all started, but once we did actually set it up, we were able to throw in some derivatives into the managed account world.